Good morning. Welcome to our regular second Saturday webinar to discuss the current market scenario. We will first see the presentation, then we will look into the recommendations for this month. Markets are on consolidation further. If you see, for almost 1.5 years, Nifty is moving around a narrow range, but some positive green shoots are emerging on markets now. First, the global markets are relatively very stable now, in spite of last month collapse of few banks in US. Global markets did not react very panically. In fact, some of the European markets are reaching their all-time high. Some of the markets like a German DAX just 3% away from all-time high, and markets like France and are at all-time high. So global markets, if you see, there are very good signs of stability emerging. And in our markets, for the last few days, for last 5 trading days, many small caps have started going up. Broader market has seen very good action in the last 5 days. But if you see the last 1 year, many stocks has corrected almost 40-50%. Some of the favorite stocks like IEX, Lotus Lab, most of them have corrected more than 50%. And one interesting event to emerge is that US Fed, which was on continuous hike in interest rate for the last 1 year, there are signs that US Fed may pause interest rates at current rate. After the banking crisis came, US Fed may think of stopping interest rate hike in coming meetings. Another interesting observation which is going on globally is that gold has rallied very smartly. In the last 1 year, it has outperformed, and in dollar terms, it is almost at all-time high. And in rupee term, due to steep depreciation of our rupee, gold is continuously going up. And in index watch, if you see, Nifty and Sensex are up by 1% in the last 1 month between last second Saturday meeting and now. And mid cap and small cap, they have corrected almost 1%. So overall, a narrow range in the last 1 month. This is the FY 2023 index performance, and if you see that Nifty and Sensex almost ended flat. So it's overall a very flat year for the market. Sensex up by 0.7%, whereas Nifty down by 0.6%. So a small divergence between Sensex and Nifty, mainly because in Nifty we have some Adani shares which fell recently. That led to small underperformance of Nifty. Other than that, Sensex and Nifty almost ended flat. So the index which did well in the last 1 year is surprisingly Nifty PSU Bank, which is up by almost 36%. FMCG also did reasonably well by 26%. So the entire 26% outperformance by FMCG index is mainly led by ITC. We discussed about ITC last month in a separate chart, in a slide, and ITC has a huge weightage in Nifty FMCG index, and ITC has done relatively well, and it is one of the biggest outperformer. That has led to Nifty FMCG doing very well in the last 1 year. Auto did reasonably well by 16% and bank by 11%. Mid cap index also ended flat in the last 1 year, just 1% up in the last 1 year. And if you see the underperforming index, it is mainly IT index, which is down by 21%. Nifty Media down by 28%, but it relatively, it don't have much weightage, mainly because it has stocks like Z Entertainment, PVR Cinemas, which are mainly mid-cap stocks. So Nifty Media, no one has huge exposure. So Nifty IT is a biggest underperformer among all sectoral index. It is down by 21%, Reality by 16%, Metals by 14%, and pharmaceuticals by 11%. And interestingly, Nifty small cap index is down by 13%. So overall, if you see that large cap index were flat in the last 1 year, mid cap also flat, whereas small cap down by 14%. But majority of the portfolio, if you see, anywhere down between 5 to 10% in the last 1 year. And top performers among index stocks, if you see that, it is nothing other than ITC. It is up by almost 52% in the last 1 year. And if you just 2 years back, it is one of the most mocked stock in Twitter and in Facebook. In social media, if you see, because the stock was stuck around 200 levels and everyone was mocking ITC stock. But if you see in the last 1 year, it is one of the best performing index stocks. And those who don't have this ITC, they have most probably they have underperformed the index. It is down. ITC is up by 52%. And in Sensex, if you see, it has almost 6% weightage. And the next stock which did very well is Mahindra and Mahindra M&M. NTPC, Hindustan Unilever did very well. Larsen Toubro also did reasonably well. And it is looking very bullish, both fundamentally and technically, even at current price, L&T. I'm talking about L&T. Among losers, major losers, if you see, Bajaj Twins, that is Bajaj Finserv and Bajaj Finance, both were down up between 20 to 25%. And similarly, other tech stocks, Infosys, Tech Mahindra, Wipro, they are all were top losers among index stocks. Infosys down by 25, Tech Mahindra by 26, and Wipro by almost 38%. It is down. Even at current price, Wipro does not look good among IT stocks. Infosys looks relatively better among the IT stocks. So the whenever market consolidates or in a downturn market, the first impact we will see is in IPO market. And if you see that the new fund offerings has completely dried down, and in the last financial year, FY23, just 7,600 crores has been raised when compared to 28,000 previous year. And in FY21, almost 78,000 crores has been raised. So in the last 4 years, if you see that almost 51,000 crores, 78,000 crores, 28,000 crores was raised through a IPO, whereas in FY23, it was 7,600 crores. Just 7,600 crores was raised, mainly because during lackluster market or sideways market or in downturn market, the first impact generally we see is on IPO market, and we have seen the impact in the last financial year. One surprising event happened in the last 1 month was that debt fund government has removed long-term capital gain tax benefits in debt funds. So during budget time, pre-budget time, there was widely anticipated that government may tweak some capital gain structure among various asset class. But in budget, nothing has came. But surprisingly, when in amendments of finance bill, some changes government has made. One was that long-term capital gain tax on debt funds, government has removed that. Previously, it was if you invest in a debt fund with more than 3 years, then you can claim long-term capital gain exemptions. You have to pay only 20% tax on long-term capital gains. Additionally, you can claim indexation. Government has removed that, and a debt fund now it will be taxed. Whatever gain you have, whether you hold it for less than 3 years or more than 3 years, it will be treated as short-term capital gains, and it will be taxed with our as per our income slab. And it's one of the major negative surprise for many of the investors who do invest in debt funds. Mainly long-term debt funds, generally corporates only invest, and certain part retail also may park some money. But other than that, it will not have impact majority of the retail investors. So how government clarifies termed it as debt fund is that if a fund invest less than 35% in equity, then it will treat it as debt funds, and that these type of funds will lose long-term capital gain tax benefit. It came just one day before the budget was passed in the parliament. The other negative surprise came was that government increased STT on and derivative transaction, both in futures as well as in options trading. So whenever you sell a futures position or you sell an options, then STT you have to pay, and that has been increased. These two came only on the amendments of finance bill, and it was not disclosed during the budget. So it is a big negative surprise for the market. So a certain part of debt fund inflows may get affected in coming days, and those who have invested before March 31st, it will not have any impact on that. From 1st of April onwards, those who are investing in debt funds, this long-term capital gain benefits may go away, and it will have some impact on long-term debt money inflows into the mutual funds. Some of the funds like liquid funds will not get affected because mostly these are short-term money which are getting parked in the liquid funds. Mostly people do invest for a few months or few weeks, or maximum 1 year they may park money in liquid funds, but they will not get affected. Only funds which are invested with more than 3 years tenure, they may get affected. Because of the changes done, the inflows, if you see that in the last week of March, government actually announced this on 24th of March. And if you see that after that, huge inflows came into the debt funds. Target maturity funds almost 13,000 crores, corporate bonds almost 9,500 crores, banking and PSU 3,300 crores, dynamic bond fund 2,800 crores, gilt fund 2,600 crores. Almost 30,000 crores worth of inflows came to the debt fund in order to avail the long-term capital gain benefits in future. They have parked a huge sum of money in the debt fund in the last week of March. This is one interesting asset class which is doing exceedingly well, which is nothing but the gold. Gold has touched all-time high. In the Indian market, it has been continuously going up. And if you see in the US market in dollar terms, gold has touched almost all-time high of 2,000, more than $2,000 per ounce. And in kg terms, it has crossed almost $65,000 per $65 in US. Whereas in India, the price has comfortably gone above 5,500 rupees per gram, mainly because of rupee depreciation. Gold as an asset class has been doing very well in rupee terms. And one of the main reasons why gold prices are going up is that there is a strong talk of de-dollarization of the world economy. Recently, after the Russia-Ukraine war, many European countries and US has put sanction on Russia. This forced Russia to do trade in their respective currency in ruble terms. And because of sanction, they cannot do trading in dollar terms. So that forced Russia to do trade in ruble terms, which means that those who are buying crude oil from Russia, they cannot pay in dollar terms because of the sanctions imposed on Russia. And they are selling crude oil to India, China, and most of the payment has been happening only in their currencies, either through, say, for example, India is buying crude oil from Russia, means it is either settled through ruble or through rupee, because India can no longer give in dollar terms to Russia because of the sanctions. Similarly, China is buying a lot of crude oil from Russia, and they are settling through either ruble or yuan. And because of this, what is happening is that there is a strong word emerging globally that de-dollarization is the word which is emerging, which means that till now, majority of the global trades, everything happens in dollar terms. in US dollar terms. Now, slowly, one by one country, they want to de-risk their currency, and they started negotiation individually with other partner currencies so that trade can happen with their respective currencies. Already, Russia, China, India are doing transactions in their own currency. Now, recently, what happened was that China and Saudi Arabia, in the last couple of weeks back, they agreed to settle trade in yuan. Russia imports a lot of crude oil from Saudi Arabia, and Saudi Arabia agreed. Till now, China was paying in US dollar to Saudi Arabia for crude oil they are buying. Now, Saudi Arabia has agreed that the crude oil trades happening between Saudi Arabia and China, they are interested to settle in Chinese currency yuan. Like that, multiple bilateral agreements are happening to do trade in respective currency. And the recent one was that between China and Brazil, where both countries are interested to do to settle their trade in their respective currencies. And like that, so many bilateral agreements are happening. Even in India, if you see, India is interested to do trade in rupee with some of the countries like Sri Lanka, Bangladesh, and our neighboring countries. India is ready to do transactions in Indian rupee. So like that, multiple bilateral agreements are happening to do trade in respective currencies, which means that the importance of dollar will get reduced. It will be very negative for it will be very negative for US in long term, because suppose if US loses its reserve currency status, means then it will have huge negative impact on US economy, because right now all the trade deficits are financed because of most of the countries are holding US dollars as reserves. All the trade deficits are financed for US are financed only through the reserves of other countries. So Saudi Arabia is holding huge reserves of US dollar. Similarly, China is holding huge reserves. Even India is holding huge reserves of US dollar. These and all are mainly for financing the trade deficit of US. Similarly, if you see that Japan is holding a huge reserves of US dollar. Suppose if US dollar loses its reserve currency status, means then all these reserves may lose its importance. And because of that, now instead of adding dollar reserves, most of the central banks are preferring adding gold to their reserves. And if you see in the last 12-13 months, all the central banks are adding gold. And every month, most of the central banks are buying the 30 tons of gold every month. And in the last 1 year, almost 300 tons of gold has been bought by global central banks. And because of dollar may lose its reserve currency status gradually, central banks are more interested in adding gold to their reserves instead of holding US dollar. So because of this, what we feel is that gold may continuously go up because of buying by central banks. And it is a very important slide. This is one. We are seeing that so many stocks are going up, coming down. And if you see in the last 1 year, many stocks have fell by 40-50%. And in the last 2-3 years, many stocks have gone by 50%, 100%, even sometimes 200%, 300%. And one important thing we have to see is that on a long period, each and every stock are slave to their earnings. The stock price depends upon the earnings growth. And in near term, we may see some fluctuation, some deviation from earnings. But over a period of time, over 10-year period, 20-year period, if you see that most of the time, stock price will track the earnings growth. And this is one of the important chart which shows that in Nifty 50 between 2007 and 22, almost 15 years period time, profit after growth of Nifty 50 stocks has been compared with market cap CAGR. And if you see that private banks in the last 15 years, private banks profitability has gone by almost to 21%. And if you see that stock price has also gone up by near to 20%. Almost what profitability has gone up, the stock price also has gone up, maybe slightly lower. 1% it is lower than what earnings has grown. And if you see the capital goods, yeah, profitability has gone up by 10%, whereas stock by around 12%. And chemicals profitability has gone up by 19%, whereas market cap of the chemical companies in Nifty 50 has gone up by 16%. Consumer is the only deviation where the profitability has gone up by 12%, whereas the market cap has gone up by 17%. So the big deviation is mainly due to PE re-rating. Previously, historically, if you see that the PE ratio of consumer companies were trading around 30-35%, 35 PE, whereas now it is trading around 45-50 PE. It is trading most of the FMCG stocks. So because of the PE re-rating, the market cap has gone higher than the profitability. And long run, if you see after 5 years or 10 years, if you see again, mostly the consumer stocks market cap CAGR and PAT CAGR, mostly it will be in line. And healthcare, also some deviation is there, whereas in metals, oil and gas, technology, exactly what profit growth it has happened in the last 15 years, market cap has gone to that same extent. Just 1% here and there it will be there. So only deviation what we are seeing is in FMCG stocks, where the profitability growth is lower than the market cap growth. But we feel that it will get corrected in coming years. Either earnings will go up or stock price will remain stagnant, so that earnings will catch up with the market cap CAGR. So this is one important slide. Just stock price won't go up blindly or come down blindly. Most time it will track how earnings are growing, and the stock price are slaves to earnings. This one line we should not forget while we buy or sell shares. And we have to track one important thing is, if you ask me, I will tell that it is only the earnings that matter. During bull market, what used to happen is that the PE ratio used to expand, and while in bear market, what used to happen is that PE ratio tend to contract. But at long term, generally the stock price will track the earnings, and it will move in line with earnings growth. And next two slides also very important on long-term perspective on our market. And in today's presentation, I have added many slides which are mostly data based. And if you see that India middle class population in the world, if you see that India has the largest middle class population with 37 crores, whereas China has just a 30 crore middle class population, 20% lesser than India, and Indonesia 8 crore, and then you have this Thailand 2.5 crores, Taiwan 75 lakhs, then Malaysia then 84 lakhs. And if you see that middle class population, India has the largest middle class population in the world, and we all know that it is the middle class population which consumes more. As we get older, the consumption pattern tend to come lower. The traveling will come lower, then consumption also will come lower. Only the middle class used to consume a lot. And if you see the countries like Japan, where they have mainly aged population, the consumption keeps on coming down. That is why, in spite of all government efforts to boost the economy is almost stagnant for more than 10-20 years, mainly because they don't have middle class population to consume more, in spite of all the efforts taken by the government. So because of very high middle class population, India will do well over a period of time. Though in the last 2 years, FIIs has been selling in our market. I expect that FII will come back. Moreover, now the valuation is a premium which India had a huge difference with other emerging markets, that also has come down, which will force FIIs either not to sell heavily or to start buying. Because in long run, India has a huge potential, mainly because our population is very high. Our consumption will keep on increasing from will keep on increasing from in coming years. And this is also an important data. And this, at present, this is the chart given by Morgan Stanley research. And if you see that right now, our household based on income distribution, if you see that it is almost like a pyramid, where the lower income has almost 38% of population. Slightly above higher income, it is middle class income, it is 36. Almost 75% of our population now either in lower income household or in the middle income household. Whereas 10 years from now, 2031, that is from 10 years, almost almost 8-9 years from now, if you see that the pyramid pattern is changed into a V-shaped pattern, at least in the bottom, if you see that, where the lower income group from 38% in 2021, it will shrink to 13%, and middle class from 36, it will shrink to 34. Whereas those who are having 10,000 to 35,000 income distribution, $35,000 income distribution, it will expand massively from 24 to 46, almost double. So the most of the household which are having either lower income or middle class income, they will switch it to into above higher middle class income. From 24%, it will go to 46%, 10,000 to $35,000 income distribution. Higher class 2%, it will go to 7%. Because of the change in income distribution pattern, definitely our consumption will go up very sharply in the next 10 years, which will benefit a lot of companies. That is why you are seeing that most of the QSR companies are trading at very high valuation, in spite of they are not showing a huge profitability. The expectation is that because of increase in middle class and their income, what used to happen is that consumption also will go up, which will benefit most of the companies. So over a long period of time, India will definitely do well. On macro data, if you see that GST collection has been going up almost from 1,42,000 crores last year. In the month of March, it has gone to 1,60,000 crores income for the government GST tax collection. It is almost a 12% higher collection, and it is the second highest collection since the GST has been introduced. Almost 12% higher collection is there. 12%, mainly if you see that our inflation is around 7%, and if you remove the inflation, the net real GST collection is around 5% higher when compared to last year. Balance of payment, it has also now into positive territory. Just 2 quarters back, it was a very negative that we had a huge current account deficit. Our balance of payment also heavily negative. Now in the December quarter, it has come into positive now, balance of payment. That's why if you see that now rupee has stabilized around 82 levels, and we expect that in spite of higher trade deficit for the last many months, rupee has stabilized, and we expect that rupee will continue to trade in the narrow band in coming months, and there is a possibility of rupee appreciation also in coming months if FII inflows starts coming in. So some of the negative which we saw in the last few months, that has disappeared now. One of the major negative was that we were running very high trade deficit. Now that has came down. Similarly, the balance of payment which was negative, that has come into positive. So what is balance of payment? I will tell now. I will tell in the next chart. And many times I have told this, and again I will explain what is meant by this balance of payment. And if you balance of payment is nothing but the net for foreign inflows into a country in a certain period of time. If there is net outflow, then balance of payment will be negative, and if there is net inflow, if there is net inflow means then the balance of payment will be positive. And if you see that in December quarter, balance of payment positive means overall India as a country has received net inflow of foreign fund. And previous quarter in September quarter, if you see that the balance of payment was negative, which means that net foreign outflow was there from our country. Foreign currency outflow was there from our country. So how they calculate this means basically we have two columns. One is the current account and second one is the capital account. In current account, we have mercantile, which is nothing but the trade. Every month on the 12th of the 12th, government will release data, which is the export-import data, which majorly is the mercantile export, which is the hard items like textile, iron and steel, then gold, which are hard items, chemicals. All this will come under the mercantile export, which is nothing but the trade happening, which is what government used to disclose it every 12th of the month. And India as a country, if you see that for last many years, since I know in the last 20 years, 30 years, 40 years, India used to run a deficit on mercantile item. That means India imports more than what it exports. So the major culprit in this is the crude oil, because we Indians import more than 80% of our crude oil needs, and crude oil comes under the mercantile item, and that is why we always import more than what we export. And as a country, we run between 15 to around 20 billion trade deficit every month. And the second item under current account comes under the invisibles, which is nothing but the services. And under services, if you see that mostly India exports a lot of IT services, and India is a net exporter in the IT services and other engineering services. And if you see that most of our trade deficit is generally compensated on the services income, because we net exports our services. And the third important thing happen under the invisible is the transfer and grants, which is nothing but our NRIs who used to transfer money from their respective countries to India to their family members. For example, if suppose a person is working in US, means he will send $1,000 per month to their family in India for buying houses or for their household expenses, for their kids' education, for family expenses. They will transfer money now and then. That also India has surplus money, because in India, if you see that most of our people are working throughout the world, in African countries, in the US, in European countries, in Gulf, where every day they will transfer a lot of money to India, and that will have our surplus income. So in surplus money we have. So in invisibles, India runs a surplus, whereas in mercantile we have a deficit. And this both combined together is the current account, either current account surplus or current account deficit. But India as a country generally has a current account deficit. So in spite of we have surplus in invisible, still India as a country run with a current account deficit. And that is compensated through capital account, which is nothing but the capital account has two parts, which is the equity and debt. In equity, we have FII inflows as well as through the foreign direct investment, where the company directly invest in India. In FII means they buy shares through stock exchanges. And if you see that India is a big recipient of foreign direct investment. Suppose a company like Sony, if they want to set up a plant in India, means they will that money will come under foreign direct investment. They will come and keep a plant in India, and they invest a lot of money. Suppose a company Apple now keeping a plant in India to manufacture the iPhone, means that will come under FDI, that money. Whereas if a foreign institution buy a share in exchanges, it means that will come under FII. It will come. For example, suppose a company takes 5%. But now recently, an Australian FII bought for stake in Adani Enterprises and Adani Group companies for 18,000 crores. That and all will come under foreign institutional inflows. Basically, if you see that FII is a highly volatile flow, it will come and go anytime. If they wish, they can sell it anytime and take away. Whereas FDI is a very stable money, and it will generally stay for 10 years, or some of the money will stay for multiple decades. And if you see that when India was not having huge forex reserve in 1992, at that time only, at that time, since we need foreign funds, at that time, Manmohan Singh allowed foreign institutional investors to buy shares in our country. At that time only this FII concept came. The other thing comes under the capital account is the debt flows, where the NRIs, they will do deposit in our banks. All the banks will have a NRI deposit scheme, and they will deposit money, and that will come under debt inflows. Similarly, many corporates take external commercial borrowings, that will also come under debt inflows. Similarly, government also will take a lot of loans from World Bank and other IMF. That also will come under the debt part. So capital account, equity and debt, and current account, mercantile and invisible. So India historically has run a current account deficit, and that has been balanced by capital account. Current account deficit is 2% of GDP, means capital account we will get almost 2% of GDP. So overall it will be net flat. If it is surplus, means it will get added to reserves, and if it is a deficit, means then reserves will come down. So some of the reserves we are having around $500 billion we are having in our country. Everyone knows that. Around last week it came around $578 billion we have some forex reserves. So actually the entire forex reserves what we have, it has been built through the FII inflows. So most of the forex reserves we have now depends upon is built by sale of our equity to foreign institutional investors. Whereas if you see some of the countries like Japan, China, they too have lot of forex reserves, but they build the forex reserves mainly through the trade surplus. This mercantile trade is there now, where China and Japan, they have surplus trade, and they have built forex reserves mainly because of the mercantile trade surplus. Whereas in India, we have built forex reserves through capital flows. So that is the big difference between our forex reserves and some of the export-oriented countries' forex reserves. CPI inflation very high. Last print came in our country at 6.4. We all know that the government target CPI inflation is 4% plus or minus 2. So even if it is plus 2 means it should be around 6%. But the last print came at 6.4%, which means higher than RBI comfort level. But in spite of higher CPI inflation, this time surprisingly, a day before yesterday in RBI monetary policy meet, RBI kept the interest rate status quo. What RBI governor told was that it is just a pause in current meeting, and it should not be seen as a pivot. That means there is a possibility of a rate hike in next meeting, depending upon how data comes from globally as well as domestically. So the RBI keeping repo rate unchanged day before yesterday is a surprise to many, because the previous inflation data was higher. In spite of that, RBI kept the data unchanged, kept the repo rate unchanged, and RBI governor categorically told you should not be seen as an pivot. It should be seen only as an pause. And in coming meetings, anytime they may change, and they may again start hiking it, suppose if data comes adversely. So this is also an important chart. See, so suppose somebody has invested in bond funds in the last 1 year, 2 year. Most of them would have seen that in the last 1 year, the returns, there will not be any returns in their bond portfolio, bond mutual funds. This is because whenever interest rate goes up, means what happens is that bond prices will come down, which means that they will lose money on the bonds. Whenever interest rate comes down, means bond prices used to go up and they will make a lot of money. And if you see in the last 1 year, exactly 1 year back, US Fed started hiking interest rates. And once the interest rate starts going up, means what used to happen is that banks, generally they hold a certain percentage of their deposits in the government bonds. What used to happen is that whenever interest rates goes up, that bond will start losing their value and they will start making losses in that. So it is a phenomenon used to happen whenever there is a sharp change in interest rates, either up or down. When interest rates comes down, means they will make huge money, banks will make huge money. When interest rates start going up, means banks will lose money on their portfolio. And the last 1 year, US Fed has hiked the interest rate very sharply, and many banks in US are sitting on huge losses. And if you see that many large banks, they can tolerate this MTM losses, whereas many small banks which are overexposed to bonds, and they are sitting on huge losses. And bond portfolio generally is categorized into two. One is held to maturity, and another one is held to trading. So in bond portfolio, all banks, they will categorize their bonds into two categories. One is held to maturity, where there is no need for disclosing MTM loss, because they will keep the bond till it gets matured. And suppose if a bond has a tenure of 10 years or 20 years, means the banks will keep on holding it for 10 years or 20 years, so that there is no need for disclosing the MTM loss in that portion. Whereas held for trading means in short-term change in bond prices, they have to show in the MTM changes. When interest rates comes down, means they will show huge profit. Whereas when interest rate goes up, means they have to show losses. It is same in India also, but there is some small difference between US banks and Indian banks. And if you see that because of change in interest rates, most of the banks are sitting on huge losses, both in held to maturity category as well as held to for trading portfolio also, they are sitting on loss. Held to maturity, there is no need to worry about, because banks have decided to hold it till the bond till the bond matures. Whereas for trading portfolio, they may have to disclose the movement in the bond prices. And because of that, if you see recently, the Silicon Valley Bank gone bust, because they were forced to sell some of their bonds for a loss, which led to huge withdrawal of money from their deposit money from their bank, and bank ultimately collapsed. And many economists were warning that many small US banks are very vulnerable to the sharp hike in interest rate, and many are sitting on huge MTM loss. They have won, and time and now, and some banks will go bust in US. And because of Silicon Valley Bank going bust, US Fed took some emergency funding to many banks. Some of the banks saw a lot of deposit withdrawal. In order to support them, US Fed pumped some liquidity into the system. And if you see that the US balance sheet, which was shrinking for the last many months, again, it has expanded in the last 1 month, mainly because they have provided some support to some of the smaller banks in order to meet their deposit liquidity. Deposit in order to meet the deposit withdrawal, they have given money, which led to almost 400 billion balance sheet expansion in US Federal Reserve. FPI flows for 2 consecutive years, we have seen outflows. FY22, almost 18 billion FIs have pulled out. In FY23, 5 billion. So in Indian history, it is very rare that FIs pulled out money in 2 consecutive years. And we expect that, I personally feel that most of the FII outflow is over. Either they will remain stagnant in FY24 or some inflows may come. Moreover, dollar index is also weakening, which means that most of the FII unlikely to sell heavily in coming days. So finally, what investors should do, what I feel is that market unlikely to see major fall in coming years, unless otherwise huge geopolitical issue happens. I don't expect markets unlikely to see major fall. In fact, some of the countries where recession fears are there, their markets are doing much well than our markets. If you see most of the European markets, they are doing far better than our markets. And we fear that there is recession in the European countries and we fall. Whereas the countries which really face recession, they are doing much better. My own expectation is that markets are unlikely to see major fall. And it's a good time for portfolio building. Many stocks are trading at very reasonable valuation, and one can gradually accumulate stocks. And there is no need to panic heavily, and a good time for portfolio building. And events to watch, FPI action very important, because last 2 years FIs were continuously selling, and I expect that big FII selling unlikely to happen in coming days. And Q3 results next week onwards, Q4 results. Next week onwards, Q4 results will start coming in. Wednesday, mainly TCS will announce its results, and Thursday it is Infosys that will announce results post market hours. And after that, we will start seeing banking results will start coming in, HDFC Bank. So in next 10-20 days, many major results will start coming in, and it will give some idea. Mainly the IT company commentary, it will be very crucial because they are one of the biggest underperformers, and most of the results will come in within next 2 weeks, both large cap and mid cap IT companies, and that will give some indicator on how IT companies will do well. So this is the second Saturday presentation. We will look into the recommendations now. Some interesting events are happening in Reliance, and if you see that recently Reliance announced their entering into many new areas, into FMCG and other items. And what I am expecting is that Reliance Retail may come out with IPO within 1 year. That is what my expectation is. And 2-3 years back, they raised money from some of the private equity players. My expectation is in next 1 to 2 years, Reliance Retail may try to list its company. Is a retail company, Reliance Retail, and they may come out with a very big IPO, at least 20,000-30,000 crores IPO they may come in. And before that, Reliance stocks generally used to do well. When big IPO is coming, means in anticipation of that stock will do well. What is more interesting is that 2 weeks back, most of the foreign institutions turned very positive on Reliance Industries. Most of the major foreign institutions, everyone gave some reason for turning positive on Reliance Industries, and many of them have given target between 2,800 to 3,100 rupees. Suddenly, foreign institutions turning positive on Reliance Industries means we feel that something is going to come on Reliance Industries. And my own expectation is that Reliance Retail, there is a possibility of coming on a very big IPO in the next 6 months to 9 months. most probably they may try to complete the IPO before next general election. That is, next general election is scheduled on May 2024. So they may try to come with a very big bank IPO before that. That is what my expectation is. And most of the foreign institutions turned positive on Reliance. And I expect that index will do well, basically with good support from Reliance Industries, as it has an highest it has a higher weightage in the index. Almost a 10% weightage is there. HDFC and HDFC Bank combined together, almost 15% weightage is there. Reliance has the second highest weightage with 10%. So when Reliance does well, means naturally index will do well. The second stock we recommend is the ABB. ABB is the MNC company. The old name was Asia Brown Boveri. And if you see that the stock has been continuously doing well, both ABB and Siemens, which are the capital goods bellwether, both are doing well, and we have recommended ABB. Though the valuation looks very high, the float is very less in that. Almost 75% is owned by the promoters, foreign promoters, Swedish promoter, and the balance 25% is held by various institutions. And historically, this stock has traded at a very high multiples. In spite of very high multiples, we expect that the stock will give 10 to 15% return. And the third one, which we are very positive, is on L&T. And L&T, we expect that the stock is almost near to its lifetime high. And in spite of index at lower level, the L&T is a big outperformer in the recent downturn. And we expect that daily the company is getting some orders and they are disclosing to the stock exchange. The order book is very strong, and we expect that the next 1 year L&T will do well, and the stock also we expect to do very well. The fourth and fifth is an micro cap companies, which is the Gabriel, which they do shock absorbers, as well as they supply some equipments to railways. Their main business is the shock absorber for two-wheelers. The one big positive about the Gabriel is that they supply almost all major electric vehicle manufacturers. It's a zero debt company, and they have very good cash balance on their balance sheet. And I expect that this will do well. Previously, there is on two-wheeler equipment companies, there is a fear that that electric vehicle may slowly eat their business in coming years. Most of the companies switch to electric vehicle. But for Gabriel, there is no worry on that, because they supply to almost all major two-wheeler EV manufacturers. So that EV disruption will not affect Gabriel. And the fifth company we recommend is Orient Cement. Many times we have recommended in the past, but I feel that now the cement companies will do well. Almost if you see the major cement companies, Ultratech, Dalmia, Bharat, everything is doing well. On small cap space, if you see that Orient Cement, their valuation is extremely attractive, available at almost $40 per ton valuation, whereas the mid-size are available at $100, whereas the large companies are available more than $150 per ton. So Orient Cement, even a 50% re-rating, there is a possibility in valuation. That means around 60-70 is a fair value for Orient Cement. $60 to $70 per ton is a fair value for Orient Cement. It is now trading at $40 per ton, and there is a possibility of re-rating. That means 50% from now means the stock can go to 160 to 180 level. So these are the 5 stocks we are recommending. And the last month review, if you see that HDFC Bank has done very well, BEL Sensatech has done reasonably well, ICRA and Petronet almost flat, but we are very positive on both ICRA and Petronet LNG. Recently, the LNG prices globally has fell a lot. Natural gas prices has collapsed, which will boost consumption of natural gas in our country. That will benefit Petronet LNG. Moreover, they will give very good dividend also. ICRA rating companies, overall, we expect good time for rating companies for the next 1 to 2 years, where the bank disbursement is very high. Credit growth is very strong now, around 15%. And most of the companies are raising money through domestic bonds, because raising money abroad has become very tough now, and that will benefit rating companies. So all the three rating companies, CRISIL, ICRA, and CARE, they will get benefited because of company raising money, corporates raising money through bonds, as well as higher credit growth time. So overall, the portfolio has gone up by 2%, whereas Nifty is up by 1%. So that's it for this time. If you have any question and answer, just type it. I will answer whatever I know.